Your credit score is 714. You know this because you checked it this morning. Not from anxiety, from habit. The same way you check the weather before leaving the apartment even when you already know it's going to be cold. 714 is fine. That's what every article says. It gets you approved. It gets you through the door. What those articles don't explain is what 714 actually signals to the systems looking at it. Not confidence. Something closer to tolerance. There is a difference. The system knows the difference. You are only beginning to understand it. Here's what nobody tells you about credit scores. They don't measure how responsible you are with money. They measure how reliably you interact with debt. Those are not the same thing. A person with $60,000 in a brokerage account, no car payment, and a paid-off credit card can score lower than someone carrying 3 cards at 70% utilization, making the minimum payment every month. The score doesn't see the investment account. It doesn't see the discipline. It sees activity. It sees patterns. Once you understand that, you stop treating the score like a grade and start treating it like a language you can learn to speak. Your coworker Elena got turned down for an apartment. Stable job. 2 years at the same company. The landlord ran her credit and the answer came back no. No collections. No late payments. What she had was a score of 619 and a utilization rate of 83%. Every card close to its limit. Not because she was careless, because she paid them off every month before the due date, like she was supposed to. What nobody told her was when the balance gets reported. The answer is before you pay it off. The statement date is not the due date. The bureau sees what the balance was when the statement closed, not what it was the day after. She'd been paying in full for 2 years and the system had recorded none of it. That part doesn't appear in any welcome packet. If you carry $4,500 on a $5,000 card and pay it in full before the due date, the bureau still sees 90% utilization. The score still reflects it. You can be disciplined and look reckless at the same time. Elena didn't find this out from her bank. She found it out from you. 3 months later, her score was 54 points higher. She got the apartment. Nothing about her actual finances had changed, only the timing. You are 23. Your score is 688. You got your first card at 21, a secured card, the kind where you fund it yourself, and the bank lends it back to you at 24% interest. You used it for gas. You paid the full balance every month without fail, not because anyone told you to. You just didn't want to pay interest on fuel. 2 years later, the limit increased from $300 to $2,000. You didn't ask for that. The system looked at the pattern and moved on its own. Consistent deposits, low balance, no missed payments. It decided you were worth more rope. That phrase would make sense to you later. It didn't yet. By 26, your score is 764. Nothing dramatic got you there. You kept the oldest account open even though you hadn't used it in a year. You added one low-limit card for recurring charges. You kept combined utilization under 8%. Not from a rigid plan, but because the number felt measurable in a life where very little was. Work had performance reviews that felt arbitrary. Raises that didn't reflect the work. The score was different. You put in consistent behavior and the output was consistent. You checked it every 30 days the same way you checked the brokerage account. Data. Number reason to act. You set the phone down and went back to the morning. There was a version of you that almost closed that oldest account. It was a card from college, no rewards, no annual fee, sitting unused for 2 years. The kind of thing a budgeting article tells you to cancel for being clutter. You looked it up before you did. What you found was that the account's age counts toward your average, and closing it doesn't erase that history. It just removes it from the average going forward, which quietly drags the number down the same way losing your oldest friend would shorten the average length of your friendships, even though nothing about the friendship itself changed. You kept the card. You put a single streaming subscription on it, $6 a month, just so it wouldn't get flagged as inactive and closed by the bank itself. That's a real thing banks do. Close cards for inactivity, without asking whether you wanted to keep the history attached to your name. Nobody explains that a 15-year-old unused card is doing more for your score sitting quietly in a drawer than most of the financial decisions you'll actively make this year. The system isn't impressed by effort. It's impressed by duration. A long, boring, uneventful relationship with debt reads as safety. A short, eventful one, even a positive one, reads as something it hasn't finished evaluating yet. Then your neighbor Todd mentioned his mortgage rate, 7.2%. Same bank, same loan type, same year, same street. Your pre-approval came back at 6.4%. Todd's score was 693. That 0.8% sounds like a rounding error. On a $275,000 loan over 30 years, it isn't. It works out to tens of thousands of dollars, paid quietly, a few dollars at a time, in a monthly difference small enough that almost nobody stops to calculate where it goes. Todd wasn't reckless. Todd just hadn't spent 4 years treating a 3-digit number like a project. Todd's other mistake happened before any of that. He shopped for his mortgage the way people shop for everything else now, comparing offers, calling 4 lenders over 2 weeks, letting each one pull his credit to give him a real number instead of an estimate. 4 hard inquiries in 14 days. He assumed that was diligence. In most scoring models, it would have cost him almost nothing, since mortgage inquiries within a short window are typically bundled together and treated as one search, not 4. What actually dinged him wasn't the mortgage shopping. It was the store credit card he opened 8 months earlier for 15% off a couch, a single hard inquiry that lowered his average account age and sat on his report doing nothing for him except existing. Nobody at the furniture store mentioned that. Why would they? The discount was real. The cost showed up later, attached to a different purchase entirely, and a number Todd never connected back to a couch. That's the part that makes the system feel less like a ledger and more like a memory. It doesn't forget the small things just because they're small. It doesn't separate the request for help from the convenience purchase, the necessary inquiry from the unnecessary one. It records the action and lets the consequence land wherever it lands, sometimes years later, on something that has nothing to do with the original decision. Nobody sat you down at 21 and told you that what you did with a secured card for the next 5 years would set the interest rate on the most expensive thing you'll ever buy. Nobody said the system was already building a file while you were still deciding whether to use the card for groceries. You were just trying not to pay interest on gas. Keep it low. Pay it off. Don't think about it too much. That was the whole strategy. And inside that simple behavior, the system was already sorting you into a category, into a rate tier, into a version of your future that would cost more or less, decided before you were old enough to understand the stakes. The score also shows up in places you don't expect. Landlords check it. Certain employers check it, mostly in finance and government roles, where a low score can read as a liability before you've said a single word in the interview. Some insurers use a version of it to help set your premium. None of them are checking how good you are with money. They're checking how predictable you are inside a system built to measure exactly one thing. You found this out at 24, with an apartment that had an in-unit washer barely inside your price range, the kind of unit that doesn't last a week in a decent market. The landlord ran your credit and called back that same afternoon. You got it. What you didn't know until months later, mentioned offhand by the building manager's assistant who wasn't trying to tell you anything, was that someone else had applied the day before you. Same unit, same week. They'd been told it was no longer available roughly an hour after you submitted your application. Same income range, same job stability, more or less. The difference was a number neither of you ever saw side by side, decided by a system neither of you were in the room for. That's the unsettling part, once it sits with you. The score doesn't just open doors. It quietly closes them behind you, for someone else, without either of you finding out why. That's the part nobody tells you, because it isn't a secret. It's just not profitable to say out loud. The system was never built to reward responsibility. It was built to reward legibility, to find the people who behave the same way every single month, and quietly charge everyone else more for being harder to predict. You didn't get a 714 because you were careful. You got it because you became readable. And the only people who'll ever tell you the difference are the ones who already figured out how to read. There's no version of this where you opt out. You can ignore the number and it will still follow you into the next apartment, the next loan, the next quiet rejection you never hear the reason for. Or you can learn what it actually rewards, which has very little to do with how much you earn and almost everything to do with how consistently you behave. That's not a hopeful ending. It's just the honest one. The system was never going to explain itself to you. It was just going to keep watching and waiting for you to notice.